Hi, I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. So one of the stocks that I've been watching lately is IBM. That's International Business Machine, stock symbol IBM, of course. If you look at a chart of IBM, you'll see that a few weeks ago, the stock broke down below its 50-day moving average, 50-day simple moving average, which is about $150 a share. And the stock's been bouncing around between 140 and 150 for about a good month now. I think that IBM is going to continue within that range for the next few weeks. So I looked as to how I could set up a trade to potentially profit from that scenario. So I went through all the income trades. I know that implied volatility is pretty high across the board, so I wanted to find a way to pretty much hedge most of that off. And a great way to do that is by using a butterfly. So I continued to explore the possibilities of using a butterfly, and I noticed that the October 145 calls has a very high amount of open interest. Now that sets up perfectly. So the trade that I like specifically is buying the October 140, 145, 150 call butterfly for $1.60 or better. Now the reason why this is strong is because if the stock stays between 140 and 150, the trade can work out really well, and that's what I think is going to happen. It hedges off implied volatility, so it doesn't matter that implied volatility is really high right now. And the higher the better anyway, because this is a theta trade, and the more I make on theta, the more expensive options I can sell. And I'm selling those at the monies. I'm selling those 145 strike calls. Now again, those are the ones that have the high open interest at that strike price. What does that mean? That means there's a better chance of pinning because of that high open interest. When there's a whole lot of open contracts, there's a greater chance than statistically expected for the stock to be at 145 at expiration. That only helps me because that's exactly where I want the stock to be at expiration. So as far as management of this trade goes, I would put this on, I would hold it all the way until probably expiration day, hoping for the stock to be close to 145. It doesn't have to be exact, but close to 145. If we start to see a trend or a breakout that looks like it's going to go below 140 or below 150, I could simply take this trade off. Because it's a very low delta trade, if that trend or breakout happens in a short period of time from now, I'm probably not even going to lose that much. Therefore, I can just kind of close my trade, take a very small loss, probably nowhere near the maximum loss of 160 on this. And if it works out, I can have a really nice leverage profit. My maximum profit potential, best case scenario, is I can make $340 off my $1.60 investment. This is Dan Passarelli of MarketTaker.com here on the floor of the CME Group.